Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I offer in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linn & Associates with your afternoon financial market wrap-up, and this is for Thursday, the 2nd of March, 2017, about 4:17 p.m. Central Standard Time. A red day. In fact, I want to stand back here so you get a feel for what's going on. Where do you see up markets? I guess sugar, and on this chart board, what, the dollar index? That's it. Everything else is like the old song, you know, come with me to the sea of love. Well, the sea of red might be where this one's all at, and today was a big bad day. It doesn't help, and by the way, we were up a little bit in that gas. It doesn't help the market to see what's going on between the Democrats, the Republicans. It's almost that anything that Donald Trump does is going to be attacked, you know. And what can I say? Now, the market's acting well considering that that's all of it. And we know that we're now up at around a 77% chance, according to the CME Group website, that there's going to be a rate hike on March 15th. Okay, that probably means there's a good chance also for one in June. Fine. If after a 300-point rally in the Dow, you're giving back only 85 points, not so bad, is it? I don't think so. So correction time, and we'll see what that all means. As we go to the weekly chart in the Dow, 17,418 from the night of the Trump election all the way up to 21,162, and we've backed off now a bit here to 21,006. So the market has settled back here overall, and that's not bad when you take into account how much it did rally. You can see on a closing basis from the high close of 21,091, we're back down to 21,006. So about 85 points lower, as we can see with today's loss, and an inside trading day. Okay. When we take a look at swing lines, which are the brown line over this chart, that's all that it's doing. It's got a pattern of higher lows, higher highs, which is still bullish. And again, just like yesterday, the 20,769 number is the key. The 18-day average of closes is moving up, and I would assume that it's soon going to approach that low. It's moving up at a reasonable clip here. It's moving up on average now about 60 points a day, as you can see. We'll see what it does over the next few days. The pause here is important. To me, what I had talked to you about yesterday was more important. I said that, and if you get my twice daily newsletters and you go to see my morning video, now the morning video is for the subscriber video, I was telling people I thought the first challenge of these upper Bollinger Bands across the board was probably an area that the market's going to have some issues with, and that's because you went up so dramatic. It's happening. Okay. Momentum-wise, you still have the bullish embedded reading. So until the red line closes under 80, I still think the market will be bought on the breaks. That's what I expect. The weakening here where it's dropping back under the blue, you could get a little follow-through tomorrow. Wouldn't surprise me if you get a bit of a down. When you come to the March S&P, you got up and challenged that zone of the upper Bollinger Band. You're pulling back. And like the Dow, sort of breaking back right here. I mentioned yesterday also in the NASDAQ that you hadn't been strong enough to get up to the upper Bollinger Band here or in the Russell at that point in time, and you'll see what I'm getting at, and you are breaking back. Now, if the red line gets under 80, and it could happen, I mean, you're at 86.36, so if it closed under 80, not gets under it, but closes, odds favor that price and the 18-day average will come together and the market resets itself. In the Russell, you didn't quite get up to the Bollinger Band yesterday, but it hasn't been embedded. This market lost it way back here, and all it's done is hung around this 18-day average, going more sideways than anything else. The VIX was interesting. You know, you tried just last couple of days here to try pushing the VIX out. That was Tuesday, here's Wednesday, and today you pull right back to that 18-day average. I think I've been ultra clear to all of you that this sideways action ultimately either resolves new low, which is hard. Getting under 10, excuse me, I'm going to sneeze there. Getting under 10 and staying there could be a bit difficult. It would be easier to get a big rally to the upside because there's so much room up there and we just came from areas back here. But that would require the stock market to break, and until you get past the Trump budget, talk of the tax, the Obamacare, it's a little bit hard to think that that's going to happen. I'm not saying it can't, but that's the hard part. The June bonds, the 30-year bonds, have now swung from 152.4 to 148.23. 4-point swing, monster. And that's because the market all of a sudden pulled away from what? From the market thinking that we're talking a June rate hike. Now the March is on the table. In the June 10-year notes, you have gone from the upper Bollinger Band to the lower band, and wouldn't surprise me if you get back to the 18-day average soon. Are we trending in these two vehicles? Well, you got higher highs and lower lows, so you're definitely not. Just a hard market to try to get anything done. Interesting, because I get letters or quips, if you will, from people telling me, oh, the dollar, it's going to fall apart here, blah, blah, blah. Well, when it does, it does. But right now, the market's in a bull trend, pushing the upper Bollinger Band. Admittedly, it is overbought. Pullbacks towards that 18-day average could be the buying zone. A lot depends right now. Does this market convert and embed over next week, or does this market turn back down once the Fed gets closer to that interest rate hike? We'll find out over the next few days, obviously. I certainly don't ever preach that you buy into an upper Bollinger Band or sell into a lower one the way the euro is right here. But the problem for the euro is, if you saw the CPI numbers that came out today, while their overall CPI has jumped nicely into that 2% range for February, once you strip out food and energy, 0.9%. That's not good. That's not going to move Mr. Draghi. So that's pushing the pressure, putting the pressure down on the euro, kicking the pressure up on the dollar. But for both of them, selling into the bottom of a Bollinger Band, buying into the top, no. In the British pound, the House of Lords sent back to the House of Commons the bill for Article 50, and it's all about immigration. Let them resolve it, but until they do, this is going to weigh on this market and kick it down. In addition, the British pound might be ready to break no matter what. You know, as we get closer to the actual day where Brexit is announced and papers are given to the European Commission, I don't know. This market's saying it's in a bearish mode. It's not a bear market because you got a higher high and a lower low, and you now got several days in a row under the lower Bollinger Band, and you typically don't stay very much more than that under them. So we'll see what happens. I certainly have nothing bullish on this chart, and if you get a bearish crossover of the 18 under the 100, well, I think there's more reason to even think the bear side then. In the Japanese yen, it appears that the idea that there's going to be an imminent rate hike by the Fed is just too much for this market to withstand. But notice what's going on, and this is why I've been telling currency traders stay away from this market. These are not follow-through markets. Just go through your currency charts. Put on your Bollinger Bands. You'll avoid some of the whipsaws that these are providing. Same thing happening in the crude. You've just come from the Bollinger Band high to the low. And what did I say? You're rarely following through. In this instance, in order to get short, you had to do it in this area. And down today, where you're at, the 52.56 levels, the 100-day average. The lower Bollinger Band, 52.61. You got to 52.54 and you came right off that. Momentum is still pointing down. Is this market ready to tip over? That'll be the question that traders ask. I think the pros got out of shorts today in big ways. Gasoline falling apart. Now, normally, gasoline starts a bid in this general area. We'll have to see where that starts coming in, but this type of action is very bearish. It is not bullish. This type of action, when you spend these many days under a Bollinger Band, yes, you can get a bounce as you get to the right-hand side, but it typically doesn't go from low and just shoot up. That's been my experience, at least. I see a lot of resistance between 176.62 and 174.42 in this market. Notice how prices are still dropping away. We then get to the nat gas market, which closed higher even with a build of 7 billion cubic feet. The market was looking for a draw of 5. That number, that build, normally more bearish, didn't put the market down today. So you've lost your embedded reading. Prices have higher lows, higher highs. The odds, that's all I can tell you, are that price and the 18-day average want to come together. So that's what I am looking for at this point. Here's another thing that we're looking for right now. I want to give you access to my market research. Now, there's two ways. If you've never tried it, I want to give you a free 20-day trial. That will include access to my videos, my written updates, my oral updates. If you've had it before, I want to give you a discount on it that's going to run out tomorrow. Write down in capital letters IRA 20. If you go to our website and under the word education, that's all you got to do. You'll see subscribe, put in the code when you do so, away you go. If you haven't yet tried it, don't pay me. Give yourself 20-day free trial to this and see what this is all about. I think you'll find it very fascinating. I review in the morning, and this is where I start off the day, and I think it's the most important part of the day for many of my subscribers, my morning videos. It's where the trade ideas come flowing out of me, telling you what I think the pros are going to do, where they're going to do it, why they're going to do it, what speculators might do, and throw out a lot of what I've studied between 4 or 5 in the morning and 8:30 when I start talking. So you get a host of information there. Call us. Go to our website. If you're trying for the free offer, just click right up here. If you're trying for the free offer on some websites, it'll say click here as well. If you're trying to buy the charting software, go right to the website at www.iraepstein.com. Under the word research, you'll see subscribe. Click that. You'll get all the information right there and enter that code, IRA20. I will talk to you all tomorrow. Have a good day.